Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there. Let's take a look and see what people are sharing. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com, where I dive deeper into these topics and share my opinions on individual companies and how I'm playing this commodity bull market. Z4 Energy says U.S. horizontal rigs fall 5 to 531 versus 625 a year ago. A new cycle low for horizontal rig count. And you know where the best time to buy is? When it is low and about to turn. So do you think it's going to continue to fall? Do you think we're going to get a recession where we could see rig counts and prices decline? Or do you think we're closer to a low where it's a good buying opportunity and we could head on higher? Don't know that question by looking at this chart. We just know that the rig count is falling a little bit or a lot from a year ago. And we'll see what the data suggests going forward as we go through a bunch of these, a bunch of data is what I'll say. The world is rebounding, but not slowing. No imminent recession risks to be seen here, according to Andreas. I think that's how you pronounce his name. So this is global economic growth and PMI. We have it going up. Now, you have to get below this area, this dotted line for contracting GDP, but we are going higher here for global PMI output index. And then the global GDP QOQ, quarter over quarter annualized, generally follows that green blue PMI line. So, in his opinion, no imminent recession risks to be seen here. But there's a lot of data that suggests, unemployment data that could mean that a recession is coming. So who's right? Who's wrong? Which data do you put more weight behind? I don't know. I mean, there's so much conflicting data in the short term. And this is why it is very hard for people to nail a recession call. Here is TYX TNX on the bottom or on the top here. And then on the bottom is SILJ versus PSCE. The reason I chose these two distinct, different ETFs on the bottom there, SILJ is the Silver Junior Mining ETF, which does well when the curve uninverts. And PSCE is a small cap, inflation sensitive oil and gas energy ETF. Look how these two correlate. They're pretty much the same in terms of their correlations. When this goes down, PSCE outperforms. Now this goes down too. Now PSCE can go up when this does go up, but SILJ goes up more when this goes up. So that's the ratio there. And what's going to outperform what here? I would think that SILJ would have a good shot, but is the curve going to invert further? That is the big question that everyone is trying to figure out. I've yet to meet a millionaire in person that drives a Toyota Corolla. Maybe I have, and they just perfected the craft of stealth wealth. Do you know any millionaires driving Toyota Corolla drivers? Yes, I do. It's not Toyota Corollas. I drive a Honda Civic and a Chevrolet Aveo. My brother drives a Subaru Crosstrek, and my dad drives a Honda Cross Tour or a Mazda CX-5. We all fit this description. But guess what? No one in their right mind would know that we are millionaires. No one. So I think there's a lot of stealth wealth out there that people just don't know about. And I don't think it's as hard to become a millionaire as what most people think. And I know a lot of people who are on their path to becoming millionaires or multimillionaires, however you want to say it, that don't drive expensive cars. I would say that a lot of the people who do drive very expensive cars may or may not have wealth. So it's really difficult to know who does and who doesn't. Having a high income doesn't mean you got a lot of wealth or means that you will become wealthy, because becoming wealthy is just unspent money. That's all it is. And driving those cars isn't going to make your life any better. And I hate to say it, I prefer to drive crappy cars because I don't care about them then. If I drive a crappy car and I leave it in a airport parking lot, I'm not going to worry about it. I pay minimum for liability only insurance. I pay minimum for registration fees. I don't care if the car gets hailed on. I mean, there's so many upside positives about driving an older vehicle versus a new vehicle where your registration costs are 10 to 20 times as much. Your insurance is more, on and on and on. So I don't know. I don't know if driving a nice car or trying to measure your societal, um, what would that be, your rank in society or where you are on the hierarchy, it doesn't matter, guys. At least it doesn't matter to me. And maybe I just never got that gene where I care about any of that stuff. I don't know. But I don't. I just don't. Now, would it be cool to drive a pretty fun sports car? I love all sports cars, guys. I do. But that's also why I migrate to certain cars. I go to the driver's car. I don't care about status. I don't care about where I'm at in the hierarchy necessarily. I don't care. I just want to have fun and relax. That's where I'm at and be in very good health. Here's myself. So some people say I'm a perma commodity bull because I've been a bull since 2020 and all in on commodities and precious metals. You don't think commodity equities look bullish? I'm not sharing these company names and is reserved for the members, but look at some of these charts here. Does this not look bullish? This is a stage one base, stage two. This is a wave one, wave three, and then wave five, and then you get the big pullback. We've gone through stage one base and we're going into stage two here of this breakout. And here's another one. Downtrend, stage one base, which is an inverted shoulder, head, shoulder, and then the projected move of this inverted head and shoulders. Maybe this is right, maybe it's not. I don't necessarily know, but this is a very big pattern, and I just buy these patterns because once they break, it's going to be a lot of fun and a big move. And here's another one. Here is the last bull market from 1990 to 2005, 10,550%. The bottom in 2020. Now we're putting in a shoulder, head, shoulder pattern that's ready to break to the upside. We're at $66. The projected move is back to its ultimate peak of about $1,000. Those don't look good to you? I'm in them. I'm going to ride them, guys, until this bull market's done. Are you telling me that there's better opportunities than these? You're telling me there's better looking charts and buying in the bottom down here than these? You tell me that there's better looking charts than this in technology that are about to go up this amount, that the risk reward and the symmetry in these are that good. Yes, technology stocks have gone up a lot, but the symmetry is not there anymore, guys. It's done. The trade is basically over. Can it go up another double? It could, but the symmetry is not there. Your risk reward is favorable in commodities. It's not favorable in other sectors like they are in commodities. So I stick with logic. I don't chase price movements. And the logic determines that I should be in these undervalued assets with great technical chart setups. It's that simple. Coming on down, we've got, for the sake of Americans, the resistance line better hold. And this is gold divided by the consumer price index, and this thing's ready to break out here. Gold's about to rip it against the consumer price index for a period of time. And that occurred back when commodities ripped it from 2001 onward. We're right there on like a huge continuation cup and handle pattern. Are you telling me that you wouldn't want to be in precious metals and commodities when this rips? Do you know the opportunities that are ahead of us? It's ridiculous, guys. Like, we are going to do another 1970s right here. Like, I don't know what is the cause of it. I can't tell you yet. The narrative and the news comes out after the breakout. So the breakout occurs. Maybe we'll do some bank savings bailout plan that you've never seen before of like $20 trillion. I'm just guessing. But something like that could come out and it's going to rip. Crude oil against uranium. Crude oil looking cheap, and perhaps we can outperform. We've got this three hump consolidation here of a falling wedge. And maybe crude oil is ready to rip it here. Crude oil is looking pretty good against a lot of stuff. I'm going to show you some more charts here, guys. Here's crude oil versus silver. I'm a big silver bull. Don't get me wrong, guys. And this chart, I'll read it here, almost looks like a back test for crude oil on a falling wedge. What does this mean? We consolidated through, we've broken out, and now we're consolidating back on top of the pattern. Are we going to see crude oil rip it here? Or is silver going to rip it? And that is really the question that everyone should be asking, is what market conditions are coming next? Are we going to see some gigantic move in like stimulus or something like that where crude oil and silver go first and then crude catches up? Are we going to get a recession where gold and silver move higher and crude oil goes down? Who's got this right? What's all the data saying? And I don't know, guys. Like, I look at data and I see a nice, pretty big split in the data. You can see and look at liquidity. You can see and you can look at the PMI that we just looked at, which looks bullish for oil. Then you can look at unemployment, which looks bullish for gold and silver and not for oil, that a potential recession is coming. Or maybe we get some weird mix of all of it where they print a buttload of money for some reason. Everything goes up and we get a recession. Is that possible? Maybe massive stagflation. In that case, I would think gold and silver would do very well. It says a lot of people love gold, but what does this ratio chart say in the long term? Could crude oil outperform gold? It kind of looks like it to me. And this is crude oil versus gold, and you can see the three hump consolidation and the breakout. And then if you zoom in on this right-hand side, you see a three hump consolidation that looks ready to almost break out at any second. Is crude oil going to outperform here, or are we going to get a recession? Is this chart suggesting one or the other? You know, obviously we have to wait for a breakout to know for sure, but I'm just showing you data on some of the patterns that are coming up and what I'm seeing and some of the things that I'm looking at. And I'll be honest, guys, I don't know which direction it's necessarily going to go. I'm looking for cues. I'm looking at data, and the data is split. It says oil outperforming the SPX tells us about the market conditions we are in. Last commodities bull market was in 98, 99 to 2008. We have broken to the upside of the falling wedge of this ratio in 2021. Where do you think this ratio will head in the future? So when I zoomed in today of another falling wedge playing out, this is crude oil versus the S&P 500. 1, 2, 3 hump consolidation, just like the all commodities charts that we look at. A breakout in 2021. And then we've got another consolidation occurring, 1, 2, 3 of this ratio of crude oil versus SPX, just like we saw above. So is crude oil ready to outperform everything? It's sitting on top of patterns. It's got the consolidation basically primed and ready to go here. So we'll see. I'm going to wait and see. And obviously the market conditions are going to determine which direction it goes. Are we going to get a recession where it goes down? Or are we going to get some weird stagflationary environment where oil goes up and the S&P 500 goes down? Difficult to say. Difficult to say. Oil and SPX is underneath it. When oil increases, we are in an inflationary environment, rates increase, and stocks generally move sideways. When oil consolidates, the SPX goes higher. What is the next move here? So we've got these big moves, and the green lines are the big moves in oil. And when you look at the S&P 500 on the bottom, you see how that consolidates sideways in a three-hump consolidation, one hump, two hump, three hump, and then it breaks. One hump, two hump, third hump, and then it breaks. Are we starting that three-hump consolidation? We very well could be. Because look at where oil is located. We had a three-hump consolidation in oil. It broke out, did a retest here in the early 2000s, and then it ran all the way up. It had a next big leg higher. That was the big leg that everybody wished they invested in. Well, what do we have here? One hump, two hump, three hump consolidation, a breakout of that trend line, and we're in the same spot as the circle is at the beginning of that bull market. Now, do we have one last leg lower? It's possible where we get a slowdown like 2001, and then we rip in oil like we've never seen before, or like we've seen in 2000s or the 70s. So all of these setups are very similar. Now, is this going to get a one last washed out sale? I don't know. No one knows that. And that's something what we're looking for. We're going to see if one, maybe we get one last hurrah to the downside before we rip. But generally speaking, when you're above support like this and you've broken the consolidation is broken, which means we're game on for upside. We just don't know what the retest looks like yet, or if it's already retested enough. And this is the 10-year yields. So oil and 10-year yields do move together. Last 2000s bull market was this guy here with the rates going up like this. It was in a big declining interest rate environment. This was the 70s back here. I am proposing that we're going to do it in a rising interest rate environment, which could be further jet fuel for oil prices. So rates and oil move together. And rates have broken this 40-year downtrend to the upside, just like oil's broken its consolidation to the upside. You see the correlations there. They are correlated. Now, why do I think the S&P 500 is going to trade sideways? Because every time oil's done this, the S&P's traded sideways. So that's why I am watching and looking at these investments versus others. Platinum times palladium times rhodium gives you the total movement of all metals combined of the platinum group metal area. Nice accumulation cylinder last bull market. Have we started working on it this bull market? So this was the last bull market from 2016 onward. You can see a big consolidation kind of accumulation cylinder, and then we broke out of it. This is the potential accumulation cylinder that we're seeing here in platinum, palladium, and rhodium. They're all multiplied together, and you can see it kind of working its way on up. Higher lows, higher highs, and are we going to get a breakout to the upside at some point? I don't know. And this is what it looks like. This was the accumulation cylinder at the bottom and the big move. Is this another accumulation cylinder that is occurring over here? I tend to think it is. But again, time will tell. And where you make a lot of money is when you accumulate in these areas and wait for the big move. Accumulate in the area that's coming here over the next year or two and wait for the big move. That's how I view it. It's a fractal of Apple stock before a huge run-up. Livermore accumulation cylinder. Iron ore, does it have an accumulation cylinder? 1, 2, 3, 4, 5, 6, 7, and then boom, the huge break. That's the accumulation cylinder, and it looks like it almost did another one on top of this as it goes on up. Here is iron ore. 1, 2, 3, 4, 5, 6, 7. Is this an accumulation cylinder? Where we could get a big break in iron ore, which would be great for iron ore companies and steel companies. I don't know, but it kind of looks similar. That's what I'll say. Let's take some fractals of previous patterns at the beginning of bull markets. Fractals are repeating patterns that the human herd creates. A psychological extension of the herd lining up a big move looks like NVIDIA's fractal. So NVIDIA is the fractal in the blue before the takeoff. I took the fractal and overlaid it on oil. What do you think? Fractals won't align perfectly, but they can be stretched or smushed together or elongated. Perhaps it is a great fit, perhaps it is not. What do you think? So this is the fractal I grabbed from NVIDIA. It's that blue fractal there before the big run. I overlaid it on oil here, which it does match quite well before the big move up. We have another one that's overlaid here that looks like the fractal is very similar. This fractal here, smushed up a little bit, is the fractal of this for oil. Is this the lead-in before a big move? I think it is, but we don't know for sure. We're above this big consolidation pattern, and I think that there's some good upside potential. Now, are we going to get a false breakdown that does a full retest back here? That is still possible. Why do I think it's possible? Because we still have an inverted yield curve that could uninvert and could get a recession that yanks us down in a washed out scare sale down in the 60s or 50s. That is still possible. I'm not saying it's not. Just showing you guys the fractals. The very best way to make money is in a small growth company that has been profitable for a couple of years and simply goes on growing. What are we doing on the website here, guys? We're looking for those inflection points where companies are losing money to making money, and some of them have just started making money. The very best way to make money is in a small growth company that has been profitable for a couple of years and is simply goes on growing. Exactly what we're looking for. Now, you don't have to be in small growth. You can just take a company, small cap, mid cap, and a higher cost producer. And once they start to become profitable, get their debt levels to manageable levels, they start buying back shares. And if you get the commodity price to go up dramatically and you catch these big moves in commodities that I'm showing you up here, the companies absolutely go ballistic. It's like playing something where a 5-year period can return decades worth of returns. That's why I'm so interested in commodities, because of the big moves. We've got commodities have been cheap in relationship to the S&P 500 for many years. What would be the trigger for this relationship to change? And this is why I'm so bullish on commodities. Now, it doesn't mean that this has to go up immediately. I'm bullish because of the value discrepancy in relationship to history. If you had invested in the 60s and 70s, you would have made a buttload of money in the 70s. If you had invested in the late 90s, early 2000s, you would have made a buttload of money in the 2000s. And I think that is true for the 2020s. If you had invested in the early 2020s, you're going to make a buttload of money in the late to early 2020, 2030s. So this is where the value is at. This is where your asymmetric opportunities are. And we just went through that training or my opinions and strategies of how I'm deploying money and why I choose certain companies on the website there. When this occurs, your risk reward is the best. Now, here's the thing. What if this goes sideways for 6 months or another year? That's where patience is going to have to play out. Because we don't know with certainty when this will go. We know that it's undervalued and that there are deficits coming in the future. That's what's going to change this market relationship. Another thing that changes this market relationship is the real estate cycle went into a big boom, expansionary phase, and we're entering an expansionary phase right now. So all three of these big booms occurred under expansion phase. And if you look back, it's all tied to this as well. The crude oil to S&P 500, crude oil and gold breaking out against the consumer price index. All of this prior information is data for this to break to the upside. So what makes you think this is going to go? Well, if gold breaks out against the consumer price index, it did it here and it did it here. It did it both of those times. And we've got a what? Cup and handle pattern. A cup and handle pattern that's ready to break to the upside. Guys, do you know how big this is going to break? And do you know how cheap commodities are at the same time against financial assets? And what do you think financial assets are going to do? They're going to go sideways, just like they did in the 70s and just like they did in 99, 2000. That's all connected. And we're sitting on top of a pattern of oil ready to break higher. You just think that's by happenstance? You don't think that all this data isn't connected and correlated together? Of course it is. It's all interconnected. NAVCAP says with only 200,000 multifamily completions coming by 2026, I will guarantee you that rents will be going up. Barry on CNBC arguing, not intentionally, that interest rates need to go much higher. The entire pivot/cut cycle is predicated on lower rents that won't materialize. This guy is saying that we're in a squeeze in the real estate cycle. The squeeze in the real estate cycle booms commodities. It's done it every time. It did it here. It did it here. This is a big commodity bull market. It did it here in the late 70s to 80. And it did it here. So every time we've had an expansionary phase, commodities have gone higher. Every single time. And this guy's saying, look, guys, we don't have enough completions, even in multifamily homes. Rents are going up and home prices will remain resilient. Logan says, this is from Logan, last crash, housing market crash. Remember, housing in the real estate cycle is a driver of the commodities bull market. New listings data in week 2011, 400,000 listings. New listings date this week in 2024, 72,000. Does that look like a bubble? Does that feel like a bubble? The massive credit buildup and stress from 2005 to 2008 pushed 08 to 2012 new listings data. It's that forced selling pressure. I do these every weekend to remind the housing bubble boys it's not housing 2008. I know they don't have this data, so in a way, I'm just taunting them. So number of consumers with new foreclosures and bankruptcies, we're way down here. This cycle, I don't even think has gotten started, guys. At the end of the cycle, if it's driven by crap bank lending, this occurs. We don't have crap bank lending in our system, at least not yet. And we've got years ahead of us for this to get worse. Home prices will go up when this gets worse for a while. Then it will overcome to some obscene level and the whole thing does break and collapse. We're not there yet. Now, that doesn't mean that we can't get a recession like a tech bubble recession or a reconfiguration of the economy based off of an increasing interest rate environment. And oil might rip where we get a huge oil spike and maybe we get a recession from it. We'll see. Here's uranium, URA, close to a major support, says Scott, right at major support here for URA. We've got the S&P 500. It says we might still have some 9 to 10 years for the next big top to be formed. And what he's doing, he's going from circle to circle, 22 years. But the big top was formed here, so that's not really 22 years. That went through the entire cycle here. It's actually 12 years. The other one here was 12 years, roughly speaking, and we've already gone 11 years from this breakout. So we are about to turn over. He is wrong. We're going to go sideways and do another big topping formation. He's got his data wrong. From 52 all the way to late 60s, that's the time frame. From 81, 82, 83, all the way up to 2000. So his timing is off a little bit, in my opinion. Peter Lynch says people who succeed in the stock market also, oh, I already talked about that one last time. So we're going to end it there, guys. So I just wanted to go over some data that I threw together, posted it on here. I think we're entering a big commodity bull market. Just because tech goes up a little bit more doesn't mean that that we're not in it. I'm going to remain bullish on the undervalued asset and the one that I think will go up the most for the period in the market conditions that are right for it to go up on it. So I will be a bull for a lot longer in commodities until this thing plays out. It's that simple. So I'm not a perma bull. I'm bull when I need to be. And I'm a rare breed because I will stay bullish as long as the market conditions are good and the valuations are good. So that's how I ride these things. I think that the stock market will go sideways at some point and pull back and go lower for a period of time and go sideways. And that's based off of the conditions. If you want to ride this bull market with me, you can do that on the website if you'd like. We still have a coupon code Mayday that is active if you'd like to join. But that's some of the data that I go through. If you want to know what those big equity charts are, you can join and you can see what they are. We already invested in those on the website. You guys, if you're part of the website, you already know those companies. All right, guys, we'll catch you later. This is Finding Value.